today we're going to talk to you, or I'm going to talk to you guys about not the death benefit side, but the living benefit side of mutually funded whole life insurance. And I think the reason I really wanted to do this is most of us think about that it being for death benefit instead of actually realizing the living benefits of what actually it can provide to you and your family during your lifetime. So we are recording it. If you guys want copies of anything, please reach out to me and let me know. Um, so we can go ahead and hold on just a minute. Uh, all right. So copyright, we are just going to make sure if you guys want anything, just reach out to us and ask us for it and we'll send it over to you. So we are recording it. If you want a copy of the recording, it should be sent out to you to re-listen, and it should eventually be posted on the Living Wealth website as well. If you want to reach out to me specifically, my email is on the bottom as well as at the last page of the presentation. So I'm going to start with our famous Will Rogers quote: "The problem in America isn't so much what people don't know. The problem is what people think they know that just ain't so." So every day, just about when I talk about selling life insurance and why I'm selling it and how I'm using the product, 90% of most people believe that the reason why they're buying life insurance is for the death benefit, that it's just this item, a policy that is there in the event of death to protect the family, instead of viewing it as very different, that you also have living benefits as well as death benefits to that policy. Okay. And what we're going to discuss right now is the different phases of life, what you're going to learn, what insurance companies provide, and how to actually really use or turn the death benefit into a living benefit for you, yourself, your family, your loved ones. Even if you don't have anybody to leave that money to currently today, or maybe you want in the future, you can still use it as a living benefit while you're alive today. So, phases of life, okay? And most of us are probably going to be in the first phase, accumulation, but some of us are in the distribution phase. And most of us, once we graduate from this earth, we want to be able to leave a legacy to someone or an entity or keep giving in our life, even in the event of death. So, accumulation, this is where you're saving and investing your money. Most of us, what we are doing is putting it into a retirement program, a 401k, or we actually are using the life insurance policy as the system to then be able to go and invest. And I'll discuss that later. This normally is occurring during your working lifetime. So, whenever you start working to whenever you stop working, and maybe you never stop working, the accumulation phase is taking place. You're accumulating money and you have to store it somewhere in order to be able to use it or access it in the future. Most of us are storing it, though, in a retirement program or a IRA or a CD or something that we actually can't access it today. Distribution. This is when you want to take what you've accumulated in your working years and distribute it back to yourself. You want to have money to live on. Okay. You want to either have residual income or money that is flowing and growing for you today and in the future. This is usually what we call our retirement years, but individuals are retiring earlier and earlier, or they're working longer and longer because during that accumulation phase, they discovered they didn't accumulate enough money, or maybe they didn't store it in the correct vehicle because of what has happened with inflation or stock market or things like that. Now, death benefit. Most of us, if you've been around Living Wealth at all or heard Nate and I's podcast, Dollars and Nonsense, you know, very rarely do we ever discuss death benefit. It's an added bonus. And I just want to make a caveat here that the reason we don't discuss death benefit is right now we view your life insurance policy as a living benefit for you. The death benefit is future dollars that you're going to pass to someone or an organization. But today, while you're alive, you need cash to live. So when you want to know why don't we talk about death benefit, I want to ask you guys a question today. How often today have you thought about money? And answer that for yourself. How many times today have you honestly thought about money? And then the second question is, how often today have you thought about death? More than likely, we have thought about money a lot more than we've thought about death. The death benefit is a bonus, okay? But the death benefit is a way to structure your distribution phase. It doesn't impact cash flow based off the stock market because it's not tied to the stock market, okay? It actually allows you to preserve the legacy of your family by using the cash value in your life insurance policy. And the death benefit by life insurance companies is now considered a living benefit as well. And I'll explain that a little more. Now, what does this insurance company provide to you? You, first of all, and it's not even on here, you are now a shareholder. You are an owner in this company that gets to determine and reap the benefit of how the insurance company does. So, Nate and I've said this a lot, but the insurance company actually, when you own a policy, works for you because they've got to produce good dividends for you to want to stay working with the insurance company. So, they provide a consistent high rate of growth. What I mean by that is there's a guaranteed value of growth in your policy. And it might not seem high in an investment arena, okay? But it is high in the consideration of that it's better than a CD at your bank. It's better than most savings account. And in reality, it actually has the guaranteed rate versus the stock market and 401ks, which fluctuate because of how they're invested in the stock market, right? So they're going to give you a consistent rate of growth. Now, the second thing and key to all of this is tax-free growth for you. That compounding that is occurring is tax-free. And the tax-free distribution, when you're taking it as loans, it is tax-free. And when it goes to your family as a death benefit, it is tax-free. Okay. And the key here is that uninterrupted compounding. As you use that cash, the money still grows for you day after day, hour after hour, second after second. So even though we take it out, we're still having that uninterrupted compounding taking place. And the last and most important is that death benefit that passes tax-free. But I wouldn't say it, I did say most important. It's not most important. It's something that you actually is a bonus that you're leaving for your family. So the bonus is that you get the cash with uninterrupted compounding and the death benefit. Okay. Now, the living benefits. Okay. Most of you should know that with your life insurance policy, there are some living benefit riders that are free that can be added onto your life insurance policy. And most of the time, you don't even realize that they're on there because your agent has marked the special box to say, yes, we want the living benefits rider. Now, it's termed differently in different states. Some is a living benefits rider, some is a chronic illness rider, and some is a terminal illness rider. The living benefits rider, what it actually allows you to do is access the death benefit for the insured in regards to long-term care. That is possible, okay, with that living benefits rider. Now, you have to meet some requirements in order to access the death benefit, but you can do that, okay? There's others that pertain to accessing the death benefit if you're chronic or terminally ill, okay? Chronic, you have rheumatoid arthritis, and it's chronic. You're never going to go away. You need some assistance or care. That means you can access the death benefit. Terminal illness, you have a guaranteed amount of time. Normally, it's less than a year that they don't expect you to live, life expectancy. And so you can access that money and use it while you're still living, whether it be for your medical care, whether it be to provide for your family, because maybe it's the primary wage earner that has become terminally ill. So these are riders that are available that you can access and use. Okay. Now, specific ways you actually can utilize your death benefit while you're living, right? What do you mean? What can we do with this death benefit while we're living? Okay. You have to realize your death benefit, because it keeps growing, it does protect from inflation. Okay. Because it's a continuing growth of death benefit, it's not just a stable death benefit. So your money today will not be worth the same as it is in the future. However, the death benefit by growing means that you have more death benefit to pass to your family in the future. Okay. It's not like that term rider. In 10 years or 20 years, that term policy, I have $250,000. That $250,000 stays the same today and in the future. Okay. So it doesn't change, even though you're giving them money. And once you graduate from this earth, if the death benefit or the term rider fell off, you don't even have that anymore. Okay. The death benefit passes to future generations. Okay, this is where we talk about the legacy of what you're going to leave. What can I leave to future generations to leave them better off than when I started? Okay, we are going to talk last about the cash value that it possesses and how it can be used today. And it provides multiple possibilities. There are so many possibilities. I think I could talk probably for a few hours of different ways people are able to use the death benefit and specifically the cash value. I'm going to go over a few. But the benefit here is you want something that protects from inflation and passes, but you can still use and access today. Okay, living benefit possibilities, the cash value side of it. Most of us really are taught that it's the death benefit side of a life insurance policy. If your policy is designed correctly, okay, then you will have cash value within the first 30 days of your policy, okay? And that cash value will benefit you and your family. You will also have the death benefit, okay? The reason the cash value is important is that basically you're going to be able to use the strong dollar today in exchange for weak dollar in the future. What I mean by that is the weakest money you're ever going to pass to anyone is the death benefit, because it's future dollars. And your dollar is not worth as much today as it is in the future, right? So it is worth more today than it is tomorrow, than it is 10 years from now. So all you're going to do is take the strong dollar today and keep it moving in motion. And we're going to exchange it for a weak dollar in the future, that death benefit, or we're going to pay it back with weak dollars, future dollars. Okay. The other key here is the uninterrupted compounding that occurs. And I've said this over and over again. Nowhere can you deposit money in any vehicle other than a life insurance policy and be able to take a loan out and that money continues to grow for you. It's uninterrupted compounding that's occurring. And the reason why is the money actually never left your policy. It's from a general pool of funds. But think about your bank account, your 401k, your Roth IRAs, any investment vehicles that you are using right now. The reason you're using it, but what you have to realize is you have to take cash out and implement it and put it into a system, right? And normally, whatever that investment is, the money has to sit, okay? In your bank account, if you pull out $200, you don't have $200 growing for you. If you pull out $10,000, the $10,000 is gone. It is not growing uninterrupted, tax-free compounding, okay? Now, what is that cash value and death benefit? With the policy, you have now implemented your own private banking system. That means that you have the system in place. Nelson talks about this a lot. It's not the investment tool, okay? It is the system you're putting in place to put your money in, but you're not just storing your money there. You're actually going to keep your money working for you. And that money is going to keep going day after day after day, growing while you're able to use it. And you can then take it and put it into an investment. You can take it and then let it not just sit in your policy because it's compounding. So you're okay, it's compounding. But now you've implemented your own private banking system. And even if it's to buy a car or send your kid to college or go on vacation, no matter what happens, you're never going to foreclose on yourself. But when we borrow it from someone else, they can take our possessions away. Okay. So you now have created your own private banking system where you're in control of your money. You're a shareholder and you benefit from that. Okay. And when I say endless possibilities, I'm going to tell you just a few things that we have never thought possible with our life insurance policies and the cash value from that. But endless possibilities. We can go on vacation, okay? And we can continue that vacation and run our money through the policy and make money by going on vacation, okay? The other thing, how would you like to be able to pay actually for your taxes using your life insurance policy or your charitable giving? And actually, you're going to keep paying the taxes and you're going to keep giving, and actually you're going to have more money to give more. Or if your taxes increase, because we all know taxes tend to increase and rise, you'll have the cash available to also pay for those taxes as they grow. And you actually can make money by paying your taxes using a life insurance policy. Okay. Last but not least, most of us think about investments. We think about the possibility of what we can do. The investment is what you're putting your money in. Okay. So I'm just going to encourage you that what you want to do first and foremost is you want to take your investing and your dollars and you want to put it into your policy first. Okay. Even if the investment goes south, remember the uninterrupted compounding that's taking place. Your money is still growing in the policy, regardless of what happens with the investment. Okay. But the investment is typically where you park your money, whether you're playing in the stock market, whether you are doing real estate and flipping houses, whatever that may be, your money is somewhere else being stored until you need access to it. This way, it's still growing for you in the policy and you're able to actually use it for whatever investing purpose you want to. Okay. And that's where you have to implement the program in order to have the endless possibilities. You want to send your kid to college and you want to help them out. A great way to start is using your life insurance policy and then having them, once they're out of college, be able to start paying you back at terms and conditions you decide. Okay. Now, maybe you won't see that, but it's endless in the possibilities. All right. I see that Ray has his hand raised. All right. Go ahead, Ray. All right, let me see. Can I unmute you? I'm trying to unmute Ray.
Okay. Can you hear me?
Yes.
Are you on the same slide you were?
Yes. Living benefit possibilities. Yep.
Thank you.
What do you need?
No, that's fine. I just
Okay.
want to be sure.
Okay. So Ray had want to make sure. So when we talk about endless possibilities, our goal at Living Wealth is to implement your own private banking system with your policy and then share with you how to use that policy literally as a living benefit today and all the many aspects it provides. Okay. And that really is all I have to share here today. I know it's a little short, but do we have questions that people want to ask? Any questions and answers? Or raised hands that people want to share? Okay. Any other questions? Let's see. Okay. So I see we have 41 participants. I want to make a note here for all of you today. This is our website right here. Great resource for you to listen to past presentations, webinars, content, as well as access dollars and nonsense. And I just want to encourage you, if you have questions, reach out to anybody within our office to be able to help you, or your agent to really be able to service you today. We are moving this week, so we have a new address, which is actually the old address, but this is, if you need it, this is where you're going to start sending your mail. And I'm Holly at livingwealth.com. There's Ray at livingwealth.com, Nate at livingwealth.com, and we would love to be able to answer any of your questions or help you actually implement anything I talked about today, whether that be using policies for taxes and charitable giving, whether that be accessing your living benefits and how to do that, or just getting your own privatized banking system started for you. Okay, so the question is, is there any way one can participate even when the insurance company does not approve? So I think, Judith, what you're asking is, you have an insurance company that doesn't really approve of infinite banking, but you have a life insurance policy. My answer would be to you, as a life insurance holder, you are the policy holder. You have a right to take a policy loan out from your life insurance company, and you actually can contact them and ask them to send you the forms to be able to do that. So if your agent can't help you, I would say to contact the insurance company directly. But yes, you actually can participate, even if your insurance company does not approve of infinite banking, but you do have a policy that is a mutually funded whole life insurance policy, and there is cash value. Yes, you can be able to access that cash and use it. What is a good annual budget for starting this successfully? I understand this is dedicated by age and health, I assume. The annual budget, I'm going to say, is whether you're looking at it monthly or semi-annual or annual, is that whatever your age is on a monthly basis. So I am 46, so I should be spending at least $460 a month on a policy. So I would say right at around $500 a month, or $6,000 annually is a good range of having that. If you are older and it's causing too much money for you to, you can also insure, or maybe you're uninsurable, you can insure other family members as well. So it is dictated by age. Age is the fact of age dictates the death benefit, but it also, you still can have cash. So I got 2 hands raised, so I will go to those in just a minute. Okay. Why wouldn't I spend X amount in the market and borrow from a bank at the low rates offered today? I'm going to say that because you're losing the compounding interest, number one, that it's generating through your policy. The money also provides you a death benefit should you not be able to repay the loan. And the insurance company actually doesn't put out terms and conditions of when or how you repay the loan. You should, and they do charge interest, but your bank doesn't give you uninterrupted compounding. So actually, the best way, if you really want to use the bank's money, is you can borrow from the bank, put it in a policy, and pay the bank back and make money off their money. And we can show you how to do that. The reason I would say you want to put it in your policy first is, even if it's a great stock, like let's take Apple, the rate of return on that still fluctuates. And in all honesty, at least you don't have a fluctuating guaranteed rate. You know what the rate is that's growing tax-free. And in the stock market, it's consistently fluctuating, and you actually have to pay capital gains tax on some of what you make on your investment. So this way you kind of get the best of both worlds, and that it's growing tax-free for you, but you also can use your money to go and invest it. Okay. Do all the insurance provide the health benefits? And all the insurance companies, or most of them today, do provide the living benefit side of that. It is up to your agent or the person that took your application to make sure that that is marked on there. If you have a pre-existing condition, it could disqualify you from the living benefits or chronic and terminal illness. And you apply for it when you start the policy. It's actually part of the illustration. So, but it can be added even before the policy is put into force or issued if it was somehow inadvertently forgotten or left off. So, this is not an annuity. No, it is a life insurance policy. So it is not an annuity. Yes, if you pay off your home, the equity in the home would also be a source for funding. Yes, absolutely. We can show you even how to use a home equity line of credit to fund even life insurance policies. So those are great questions. What drives the fixed rate of return? Life insurance companies, I'm going to answer the best way I would know how to answer. Life insurance companies actually are based on Austrian economics, so they're based on dollar for dollar. But the way they were established and set up was really having to deal with bonds. And with those bonds, they get a guaranteed rate of return. However, a lot of them even do other sources other than just bonds. They do loans outside of policy owners, and they invest in different things that actually drives that fixed rate of return. So when they're looking at a low interest rate environment, often you don't have a high fixed rate of return, and it's really not even a rate of return question, to be honest with you. But what drives it is actually how they have actually invested their surplus cash and what they have put their money into. And those are all based on ratings. So insurance companies are rated to see whether they are secure or whether they are more risky investments. You really want to work with an A-rated company. Those are who we work with in regards to getting that guaranteed interest rate that's tax-free and using that rate of return. So it really is multiple layers, and each company is different, but it's really based on the fact of they can't loan out money they don't have. They actually are taking care responsibly with your money because you are a shareholder, and so the dividends go back to shareholders. So just like a bank gives their benefit to shareholders, the insurance company is giving it to you. Any other questions? All right. And do we have any hands raised? Okay. Okay. Ray Poteet. Can you talk, Ray?
Yes.
Okay. Go ahead.
Question. I don't have a question anymore.
Okay.
You answered.
Okay. Okay. Oh, if I get in at a certain level, is it required I maintain that level moving forward? So the answer is you need to be able to put the money in really for 5 years. So if we're asking you to do $500 a month, I'm going to give you a typical answer. Really what you're looking at is after 5 years, your premium level drops off, the cash value drops off, and it either drops off by 50% or it's 60%. It depends on the design of the policy and age. But typically, let's say you're doing $500 a month, it would drop down to $200 or $250 a month. long term. And if we want to keep that cash value rider on there to add additional cash, it's around $100 a year or $10 a month, depending on the insurance company you're working with. Some of them are $25 a month, so it might be $300 a year. But I would say at a certain level, it's not required that you maintain that level moving forward. What you start with actually is a level that is going to drop off and decrease. That is the goal of the policy, because we don't want to leave the cash value, the paid up addition rider, on there forever, because it doesn't make your money as efficient for you. How did you calculate how much insurance payment you need by age? We actually did that because we were looking at what actually benefits and the break even level of a policy of when you can borrow out more money than you put in. And so that's the easiest answer, was to add 10 to your age to really get a policy that performs well for you from day one, as well as when that paid up addition rider falls off, it removes that. Cash value portion, but the cash value that it generated during those 5 years while being on there actually then allows you to be able to borrow out more than what you put in from there that year on. So in reality, it was a matter of, if we start too low based on your age, it takes a lot longer to get to a break even number. And I'm going to say, let's say your break even is year 7, 8, 9. Without doing enough money and your age, it can actually become year 19, 22, 23, even on younger kids, if it was not designed properly. All right. Okay, do we have any other questions today? Okay. I got one more. Do you have models that compare 10 years of this with an equal give to the stock market? The answer to that is actually, Nate and Ray have done a few webinars at different times in the past on that. If you want to have a model comparison done, I would say reach out individually to us, and we can actually show you a comparison on a screen chart, or maybe it's a great webinar for another time that actually compares 10 years of this given the stock market. We actually have even done a few podcasts on that recently, but it's a audio recording versus seeing something visually. But we can absolutely show you the comparison and contrast of that, and what it looks like in a stock market, because the stock market gives you a average rate of return, and we're going to take an actual rate of return and see how it does. But even with a average rate of return, the policy typically does do better depending on the stock. Like I said, the policy is not about rate of return. The policy is the vehicle you want to use or implement if you then want to go and use it in some way to do an investment. But I would say long term, the policy also provides you that living benefit where the stock market doesn't. Late arrival, will there be a replay of today's session? Yes, it is being recorded, and we will send out a link allowing you to be able to replay the session and listen to the recording as well as the questions that were answered. So yes, there will be a replay of today's session. Okay. Do you have information on the infinite banking process? What is the process to begin a whole life policy? So the infinite banking process, you can go to our website and find out what the infinite banking process is. You can also read the book by R. Nelson Nash called The Infinite Banking Process. What the process to begin is just setting up a time with one of our agents just to discuss where and how you want to start. You can send an email to my address, holly@livingwealth.com or info@livingwealth.com, and we can get you scheduled to answer your questions and see. It's pretty easy process to get started, but you do have to do an application, and we do have to have an idea of how much you want to start with in order to begin the process. Um, So this isn't an investment tool, but a process. Um, Kim, I agree with you 100%. We can compare it to the stock market because we get a lot of questions on rate of return. But I would say our goal for you is to actually use the policy as the process in the system and then go and put whatever you want in the stock market. But if people want a comparison, we are able to compare a whole life policy with the stock market, but the reality is, we're not really able to compare apples to apples because they're so different in their product, where a stock really is about rate of return. And a life insurance policy is not an investment. It's not considered an investment. It literally is a policy. It's just the vehicle that you're using to start the process. I would say no, it's not just focused on the living benefits, it's focused on both. You have a bonus, so there's a bonus to it. You have the living benefits and the legacy that's left for survivors. Um, I think when you learn and you've worked with us, you start to understand that we allow you the ability to use the money and the cash today, as well as to still have a legacy left for your survivors. So you get both. It's a bonus. So, but oftentimes life insurance is so focused on death benefit that we don't actually see the living benefit side of it as well. So you get both. You get the death benefit and you get the living benefit side of it. And I think that is what is most important. For me and my family, I know that we are able to use our cash today, as well as should something happen to any one of us, there is an immense legacy left for the family. So I think once you understand the design and how it's designed for your family and what that benefit is, it really is an added blessing. I say the death benefit's a bonus because you get it and you have cash. If I use the money, I essentially need to pay it back with interest to ensure I maximize the product, correct? I would tell you that you absolutely want to be paying it back, but it depends on when and how you start paying it back and how you maximize that. It's not just about paying it back with interest, but actually being able to build cash value. And I would say that's a separate conversation of the three ways a policy grows. Um, but in all honesty, you do want to pay it back, as well as pay it back with interest. And we even say sometimes extra interest, but we don't want to pay it back until we have other debts or things paid off. And that's about using that money. And what we create is what we call a financial GPS to show you how to actually pay the policy back and to recapture debt or to create cash flow. Lots of people might not have debt, but they want to have cash flow and they need to know how to use that cash and make money using their cash. Okay, what happens if at some point someone would like to cancel the contribution and services of the life insurance? You're allowed to cancel it. There is a um, surrender amount of money that they will give back to you, and you can cancel it. The other thing is, if you maybe can stop, if maybe you don't have the money to afford the policy as well, there's also what's known as premium offset to start paying those premiums. So if you want to stop contributing, you can do that as well. It just depends on what you're actually looking for and what you want to do. And I would tell you that we would want you to reach out just so we can help you through that process and see what's best for you. So it does build cash value and it's while living, and it still maintains the death benefit. Yes, it does maintain a death benefit. Yep. You get both. All right. Last call for questions. All right. If you never pay it back, it does come out of the death benefit. You are correct. You can think of the loan or the death benefit as the collateral for the loan, and it's a prepayment of the death benefit. So if I borrowed $10,000 out and I never paid it back, or I happened to have graduated from this earth before I paid it back, it means it would reduce my death benefit by the money that I'd borrowed out plus the interest due. Yes, but your cash continues to grow. Yes. Continues to grow even while it's borrowed out. Yes. Okay, I'm going to thank you all for joining me today. And should you need any information, here is our website right up here, livingwealth.com. You can email me directly, holly@livingwealth.com. You can also reach out at info@livingwealth.com, and one of our agents will be in touch with you. And you can call me 858-255-0205 or directly call our office at area code 785-842-8333. Thank you guys so much for joining us today. I really hope it was beneficial to you. And once the recording comes out, we will let you know, and you should receive an email being able to listen to it again. Thanks so much.